In this presentation, I'll look at the copper space and some of the investment opportunities that it presents. However, please note that I am not an investment advisor or a stock tipper, so please do your own research before making any investment decisions. There's arguably never been a better time for copper companies. The copper price has been just under $4 US per pound in recent years, as in addition to normal demand, industrial demand, there's increasing demand from the electrification of the energy and transportation sectors, new demand if you like, all of which require huge amounts of copper, as copper is the true critical metal. Earlier this morning, Ross Beatty pretty much said that. Even the UK Economist says so. No copper means no electric vehicles, no solar farms, no wind farms, no charging stations, no grid upgrades, no fun, and no presentations from me. The energy transition has brought a demand surge as renewables such as wind farms, wind turbines, solar farms, EVs, the charging stations they need, and the electrical grid upgrades they need all demand a lot of copper. This is forecast to grow copper demand from about 25 million tons per year now up towards 40 million tons per year by 2040. That's huge demand growth. And this is why copper has been included in the Canadian Critical Minerals Strategy, the US Department of Energy list of critical minerals, and the EU Critical Raw Materials Act. The demand growth is forecast to open a supply gap of 5 to 10 million tons per year by 2035. That's about 20 to 40% of current supply. And this is largely because of the lack of a supply response. Miners cannot bring on new supply fast enough to meet this growth in demand. The supply response is challenged for several reasons. First, existing mines are experiencing declining grade over time, which means they get less copper for each ton mined. The average grade in Chile, which is the world's largest copper producer, has fallen over the years and is now about 0.5% copper. Worldwide, the average grade is about 0.6%. This makes deposits like Ivanhoe Mines, Kamoa-Kakula in the Democratic Republic of Congo at 5.5% really stand out. Declining grade also means that development stage projects like McEwen Copper's Los Azules and Andes Copper's Vizcachitas, which a decade ago were marginal, are now at production grade and potentially ripe for development. Added to this, the discovery rate has fallen as the easier to find deposits have been found. Explorers increasingly have to look deeper or in complex geological settings or in areas where there is a lot of cover or increased country political risk. In addition to exploration time, cost and regulation continue to increase, while the pool of exploration professionals to find them is decreasing because the older folks with all the knowledge and experience are retiring and younger folks aren't coming into the sector. This in turn means there is a paucity of deposits in the copper development pipeline. These are about 30 or so of the largest undeveloped copper projects here. And relatively few of these are projects held by juniors. The ones highlighted in yellow are held by juniors and perhaps represent the best investment opportunities. As such, these could be the investment opportunities as sooner or later the big companies will need to buy these projects if they're to go on maintaining and potentially increasing their production. However, of the 30 or so projects shown on the previous slide, 3/4 of them face challenges of one sort or another to get into production, and the potential risks are only increasing. Challenges mean, a very simple, simplistic view, increased costs and longer timelines, and also the potential to stop a project dead in its tracks. Last year saw the supply side falter with the closure of the Cobre Panama mine, Anglo American announcing production cutbacks in order to manage their costs, as did Rio Tinto. So all in all, the development risks are increasing. These include the technical risks of building bigger, more complex projects, the cost risks associated with bigger, more expensive projects, country risks, social risks, financing risks, and executive risks. For example, the cost of Tech Resources' QB2 development project ballooned from an original $4 billion to almost $9 billion. This added financial strain to the company. It cost the COO, the Chief Operating Officer, his job, and more broadly, I would say, creates disincentives for executive teams and boards to greenlight investment in multi-billion dollars, multi-year development projects in what is still an inflationary environment. So what does this mean for the incentive price for the development of new copper projects? With all the risks involved and the scarcity of development projects, $4 per pound really is not a realistic incentive price. Even if at that price, projects can make a lot of money. The good thing about the copper price has been just under $4 per pound for quite a while now. Copper miners are making good margins and are making very good money at the moment. But that doesn't, and it's not translating into companies greenlighting new development projects. Copper Bull Robert Friedland says $15,000 per ton, which is about $7 per pound, is needed, almost double the current price, copper price, to incentivize the development of new production. The question, of course, is when. The paucity of projects also means M&A will happen. The bigger companies will need to buy the projects that are out there, even though they may have challenges, even though there's not that many of them. M&A is less likely amongst the producers because they're a relatively small group of companies and they're relatively large. But it is the juniors that hold the development projects that are increasingly likely to come into play. Shown here are a few of the targets, but they are targets nonetheless, and deals are starting to happen. The past 12 months have seen strategic investments made by Stellantis into McEwen Copper, for example, and just a week or so ago, Zijin Mining investing $130 million into Solaris Resources to get access to its Warintza copper project in Ecuador. SolGold, a name that's very well known and has been for a number of years, has a strategic process underway to find a buyer for its Cascabel project, also in Ecuador. Well, vultures are circling First Quantum Minerals, looking to pick off some of its assets following the closure of Cobre Panama and the change that's made to the company's financial outlook. All of that taken into account, I'm going to leave you some names that I think would be worthwhile to look into. Ero Copper operates in Brazil. Arizona Sonoran Copper, they've got a development stage project in Arizona. Faraday Copper also has a project in Arizona. Tribeca Resources, an early stage explorer in Chile. American Pacific, project in Canada. Hercules Silver, they made an important discovery in Idaho, which immediately, after one drill hole, Barrick Gold decided to invest a lot of money in them. And Hot Chili, again, they've got a development stage project in Chile. They're one of the companies on the list. We've got a few minutes left, so welcome any questions. The question was, given what happened in Panama with the Cobre Panama copper mine, is there any risk of that spreading to other countries in Latin America? I think there's always the risk of governments meddling with agreements they've already made, wanting a better deal, communities wanting a better deal. I think there will be more of that, perhaps not on the same level, because it's very unusual for a contract to be ripped up, renegotiated, and then ripped up again. I think that's a very singular situation, but I think in a broader sense, there will be governments seeking to improve the rents they get from the copper projects, maybe even seeking to obtain direct participation in the projects. In Chile, for example, perhaps not so much in the copper space, but in the lithium space, for the future development of that, the government really wants to be a sort of 50% plus one partner in any projects. We haven't yet seen that in copper projects, but I do expect that there will be increased government intervention in the development of projects going forward. The question is, what else can be done, or what else can happen for the copper price to move above that sort of $4 per pound line? I suspect it will naturally occur. Again, Ross Beatty this morning was talking about how there seems to be a disconnect between the aims and goals of politicians and the reality of actually developing new copper supply. So sooner or later, that rubber will hit the road. The demand from society and from governments for this copper to be available will reach the point where governments will either have to help subsidize the mines directly, or the only other thing that can give is the price gets high enough for the company to say, okay, we'll accept that risk. So I think it's a matter of time. How does the Chinese economy affect the copper price and the building of the copper price? Well, China's the main consumer of copper. And so that really has been the bellwether for the copper price, what's happening in their economy and the industrialized aspect of it, and obviously the real estate sector. China's economy has been colder in the past year or so, which has kept a lid on the copper prices. But when you look at the inventory levels, particularly in Shanghai, the inventory levels of copper are very low. So it won't necessarily take a lot more demand or normal demand coming back on stream for those inventories to deplete it, and that will to push the copper price higher again. The question is, if anybody's going to start investing in the resource space, would it be a good idea to start with investing in copper? Personally, I think that is a good idea, because at the end of the day, copper's useful, copper's necessary, humanity needs copper. You could argue that that's not really the case for precious metals so much. Demand for copper is increasing, that's very real. As I mentioned, there's a very limited supply response, that is very real. And so to start out, perhaps looking at some of the copper producers, I mentioned Ero Copper, but Freeport-McMoRan, Antofagasta Minerals, and there's a couple of others. They all make very good margins, they all generate a lot of free cash flow, they all pay good dividends. Well, Ero Copper's not paying a dividend yet, but the major producers are. So I think that's probably as safe a starting point as you can find in the resource space. The question, what is it that takes a copper mine so long to get into production, and what can be done to speed up that process? I think one of the fundamental things is copper deposits tend to be very, very large. A porphyry copper deposit is a huge volume of material. So it takes a long period of time to explore it, to delineate it, to find out what you've actually got. Typically, you're perhaps looking at anywhere 20 years and above. And then to go ahead and permit that, to do the economic studies and then permit that, you could be looking at another 10, 15 or 20 years. And then the construction phase can be multiple years as well, because they're big ore bodies. They need a lot of infrastructure, they need a lot of development to get to the stage where they're able to produce. Requires a lot of money, multiple billions of dollars, and a long, prolonged development time. The much talked about QB2 expansion project, they've been building that for 3 or 4 years. And obviously during that time, we experienced the inflationary environment, which really threw their economics right out the window and meant they were battling against the wind for a large part of that development time. Those long development times mean they're exposed for a long period of time for development risk, execution risk, financing risk, and the inflationary risk. That's why companies don't make investment decisions lightly. Contrast that with a gold project. Gold projects tend to be smaller volumes of material, so it takes a shorter period of time to explore and delineate. Because they're smaller, they tend to be a little bit more simpler to permit, and they take less time to build, finance, and develop. Historically, mining's answer to dealing with these kind of issues is to supersize equipment, to make it bigger and bigger and bigger. There comes a physical limit to that, which I think most people think, the equipment can't get bigger. So looking at other ways to try and do that, using technology to plan better, using artificial intelligence, using automation so that operations run or can run smoother with fewer hiccups. But there's very physical reality of the size of the deposits, the size of the equipment that one has available. That's a tough one to speed things up. The question is, are new sort of chemical processing technologies speeding things up? Not really, because that's not what they're exploring those for. Miners are exploring new processing technologies to be able to extract the copper from ores that in the past you haven't been able to leach copper from, to be able to sort of maximize the utility of an ore body. Rio Tinto's Newton, for example, is one of those. If successful, it will give a new lease of life to some existing deposits and enable the processing of things that in the past the miners haven't been able to process. And that in itself could create new sources of copper, but it's still in the stage of testing those and trying to prove that they actually do function. Thank you very much, and I appreciate all of your questions.